Thank you, Fabian. Hi, everyone. Good to see so many people here in the room and then also online. So my name is Wallentin. I'm the CFO and the Deputy CEO of Hoist. I've been here for now exactly 3 years, give or take, or add another month. My background is in financial services broadly, so I've been knocking now on 25 years in financial services. Wide range of, the red thread in my roles is value creation and creating really better companies. So that's what I've been doing in various roles: investment banking, private equity, and then in leadership positions in the banking industry. And now at Hoist, I'm heading clearly the finance function and in charge of the health of the balance sheet. Also working a lot on the strategic initiatives, rejuvenation, and sales of larger assets like the UK market. I will focus here in the capital funding on 3 key messages. It's basically we have a sustainable, low cost and diversified funding. So we built that over a long period of time. We've been a bank for a very long time. So I go through that in some detail, and it's based on the stable and sticky deposit base. And secondly, our deposit model is complemented by the investment grade market funding platform, so diversified in both the funding and then also accessing larger transactions if needed. And all of that leads to that we have a industry leading funding cost, which helps us a lot to help the banks. So this is the overall view of the deposit platforms or the funding platform. So we have 73% deposits. We're ranging more or less 70 to 75% over time. So we want to keep that at a high level because it's very cost efficient. And it's also always on. So if we need to add funding, it's very much a online thing. We can adjust rates, and we get more or less funding as required. And then we built this platform across Europe. We have attractive sourcing opportunities, and we offer attractive savings offering. And the more lumpy side of the funding is clearly the market funding. So if we grow very quickly, we want to access the funding. We want to maintain our investment grade. We think it's very important to have that flexibility. So I'll go through that a little bit more in detail on these pages here. So the funding platform. So we've been expanding. We built a well-diversified competitive funding with a stable, sticky deposit as a base. We believe this is a low-risk model, so we have it always on, and it's highly fit for purpose in our industry, believe, and also the aims that we have as a firm. And with that, I mean that given the lower funding advantage or lower funding cost, we can price attractively for the banks as well. So we do help them to get on the margin slightly better prices, given that we have such a competitive funding. So the core is the 75% funding or so, and then the investment grade. So across Europe, we offer attractive savings offering to our clients. It's now in 7 markets across Europe, and we believe that it's very low risk for these clients. We're a Swedish bank, so the risk that we're on the Swedish deposit guarantee scheme, so the risk is underlying the Swedish state, so AAA rating. So it's very much if we offer a sufficiently attractive price, then people will sign up for this. We have been expanding this and diversified this over the last few years. We come from a situation where we started in Sweden a long time ago, and now we're across 7 markets. So last year we added Poland, Netherlands, Ireland, and Austria, in total 7 markets. We also grown the savings clients from 80,000 to 120,000, and that reflects both the growth of the balance sheet and also the diversification in markets. This is all enabled by us being a credit market institution, so regulated by the Swedish FSA. The important thing about the deposit side of the business is that it's highly granular, coming back to what Lars was discussing. So this is highly diversified, and therefore we believe very low risk. So it doesn't move very quickly. So we can build up gradually, we can take it down gradually. So we see that when we have priced this, we always only offer up to the saving the deposit guarantee scheme level, so 100,000 euros. And you can see if you do the math here, so 22.3 billion SEK over 120,000 customers, it's a little bit less than 200,000, so 185 or so, and then less than 20,000 euros on average per client. So it's very, very, very diversified, which we like. And then clearly across markets as well. The funding is available in real time, which is a really important thing. So when it's like that and pricing drives volumes, we have continuous access. It's also important to say that a large part of this is a term, so it cannot leave us overnight. So when we had a turbulence in the US a year ago or so, when Credit Suisse failed, then we didn't see any impact on our deposit funding. So this is a really stable thing. Last but not least, deposits are priced highly attractive. So it's materially lower than the capital markets funding. We have an average rate of 3.33 basis points or percentage. And given that we have 7 markets as well, we can optimize pricing in these markets. So we have 4 markets in Europe, for example. So if we want to build deposits overnight, then we don't need to reprice the full stock. So we can use different markets for different purposes. And therefore, it's very easy to guide the price that we're paying and then keep the prices attractive for ourselves as we can, while still offering attractive savings offering to our clients. So in summary, we believe that we have developed a really low-cost, diversified funding platform with a deposit base. And then it's complemented by a investment grade, being an investment grade issuer in the industry. And we're alone in this, so we're the only one being investment grade currently. And we have a Ba3 positive outlook, and this is on the Moody's banking framework. So it's a very the risk level is compared with stable banks, and that's what we look at ourselves as, and that's what we are at core, because that's how we're organized and are regulated. So we have a positive ratings outlook, and we hope and believe that will materialize. We have looked, when you look at Moody's criteria for potential upgrade, we believe that we tick all of those boxes. And we will see when Moody's come back on this, but we do believe and hope that they will support our belief in that as well. This is peer pricing in the industry. So we have the deposit base as a platform, and then we complement it with the market funding. And you can see us being the slightly pink ball here. So we have these 4 on this page. We have another euro issuance, but it's very close to maturity, so we haven't included it here. And you have the pricing and then the maturity on the right-hand side. So you see that we're in the bottom left corner, which is where you want to be. So it's very cheap market funding as well compared with peers. And I think this is building on the overall attractiveness of our funding package. So we've been over the last few years, we've been building a SEC presence, as many in the room know who invested in our bonds. We believe that that's a diversification to the European EMTN program that we have. And we wanted to build a curve to being able to manage the NFSR and the more technical sides of the balance sheet in a good way as well. So now we're building a granular curve, which is more across and we also have seen a really tightening spreads since we've issued these bonds. So the journey that we've been on to improve the company has really been reflected in the pricing of our bonds as well. And we have seen a really strong demand in these bonds. As Harry mentioned, we're out in the market starting today and investigating if we can raise more funds. So we're setting up meetings with credit investors over the next few days. And in this page also, I can mention that we have excluded a few peers that are a little bit outside the chart because it's not reflecting the true business risk of the industry, the funding risk. So overall, this is a page where we have all our funding in here. It also includes the additional Tier 1 instrument that we issued, so more the capital side to make it a full comparative basis. And for our peers, it includes all the both traded and non-traded debt. There's a few minor assumptions around cost for rolling RCFs, but they're very minor. So this is broadly the picture that we are seeing in the industry. And we can see that our funding cost is it's almost half of the industry, so 78%. The average is 78% higher than the industry, than our cost of funding. So we do have a leading funding cost in the industry to support the investing and purchase of NPL portfolios.